Bloomberg Audio Studios. Podcasts, radio, news. This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
On today's Bloomberg Intelligence show, we dig inside the big business stories impacting Wall Street and the global markets.
Each and every week, we provide in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide.
Today, we'll look at a new joint venture to fund artificial intelligence infrastructure in the U.S.
Plus, we'll discuss how the energy sector will be impacted under the new Donald Trump administration.
But first, we begin with the streaming space.
Netflix shares soared to a record high this week after streaming giant reported its biggest quarterly subscriber gain in history.
For more, we were joined by Geetha Ranganathan, Bloomberg Intelligence Analyst on U.S. media.
We first asked Geetha what stood out most in Netflix's earnings.
Everything, Alex. So, it was not just, we knew they were going to have a strong quarter. It was just the magnitude of outperformance, which was simply stunning. They added 41 million subscribers throughout the year. Just for some context, that's more than the total number of subscribers that some of the streaming services even have out there. Peacock, for instance, has less than 40 million subscribers. So, just the scale of the business is absolutely astounding. And it's that scale which is now on display in every possible area, right? Whether it's revenue growth, whether it's, content cost growth and, cost per subscriber, which is going to be significantly less than, the revenue growth per subscriber, all of that. It was just, execution at the highest level.
So, Geetha, this kind of raises the question to me yet again. How do you think this industry is going to shake out? It just seems like there's Netflix. I'll give you Disney because it's Disney, but everybody else, is there any room left for any of these other traditional media players that are trying to get into the streaming business?
Paul, it's going to become more and more difficult. With Netflix getting to that 300 million subscriber milestone, they have, I would say, very much built an insurmountable lead in streaming. There's absolutely no doubt about it. They are expecting 29% operating margins. You've always posed this question. Can Netflix get to that 35% operating margin? And it looks like they're going to be able to do that very, very comfortably.
Wow.
That, leaves us to the all-important question. Can anybody else replicate this playbook? Maybe they can, but it's going to take a very long time. And I think by that time, Netflix is going to be far ahead of, rivals with probably, 40% operating margins, tons of free cash flow, and maybe even like 500 million subscribers.
Wow. So what is your question now? So say we have to be discerning and we have to say, okay, well, it's at a record, but, it's not all amazing and flowers and sunshine and stuff. What's that question?
Except it is all amazing. You're
not helping me here, Geetha.
Yeah. It is so hard to find something wrong with this report. If you were looking for, okay, is subscriber growth going to slow down? Yeah, probably it's going to slow down a little bit. But again, they've said that subscriber growth is going to be the main driver of revenue growth in 2025. Is operating income momentum slowing down? No, it's not. Are we getting double-digit revenue growth? Yes, we are. Is free cash flow there? Oh, yes, it is. So, okay, yes. I guess the big question is what are going to be 2025 is all set because you do have that subscriber momentum. You do have those price increases that are going to feed that revenue growth. So the big question then is, okay, what about 2026? What about 2027? So 2026 and 2027, I think the levers are really going to be the ad growth story. And they're putting everything in place this year so that advertising becomes a really bigger part of the revenue equation starting in 2026. And they have everything set to do that. So yes, they did raise their prices on the ad tier a little bit, just a smidge. But again, remember, it's only costing you $8 a month. That's the same as Disney Plus. So again, they have a lot more, I think, cushion to raise prices and then to also increase, their ad targeting capabilities and to really be able to charge advertisers a premium. So I think there's just so many different catalysts out there on the horizon, Alex. It's really hard to find any fault with their report here.
Because now, Paul, I feel like it's not about can you get streaming stuff for cheaper than you would on cable. It's about the contents.
Yep.
more interesting and better. I feel like that's a different thing than when I cut the cord, say, whatever, 8 years ago.
And it's what Geetha in her research calls a virtuous circle. The more subscribers you have, the more money you can spend on content, which then gets you more subscribers, and it goes and goes and goes. So, Geetha, I think the last big area for them to conquer, from my perspective, and it goes to your point about advertising being a longer-term growth driver, is live sports. When are they going to step up and jump into the deep end of the pool and take a big NFL package, not just a couple of days on Christmas, but a season package from the NFL, from the NBA, from English Premier Soccer? There's really no area they can't go. When do you think they're going to do that?
I think that's still a couple of years out, Paul. So they obviously know that the live sports strategy is working for them. There's no doubt about it. They had the two of their biggest events, which were live sports events, and you had those record subscriber gains. So obviously sports can be a big subscriber acquisition tool. It can also turn into a big subscriber retention tool. They do have a couple of things that they've signed up for. So, WWE is something that they already have for the next 5 years or so. But the next time a huge NFL package or an NBA package is really going to become available is probably going to be only in another 4 or 5 years' time. In the meantime, you do have, a couple of the smaller rights packages. You do have UFC, which is coming up for renewal by the end of this year. You do have, Formula One, which is something that they already have a pretty deep relationship with, kind of given their success with Drive to Survive. So again, they could go after that. They have the Women's World Cup. They already have got the rights to that. So it's going to be smaller investments, I would think, before they really go after that big splashy package. And by that time, their advertising would be all set. Sorry.
No, I was going to say, it's interesting. I was talking to somebody and they were like, I've never watched wrestling in my entire life, or boxing, but I did when Mike Tyson was doing it because it was on Netflix. Why not? So I also wonder if you're bringing in like a whole, you're going to want the really sexy NFL package, but do you actually need that in order to continue to grow that momentum? It's kind of amazing. So just record high after record high here. Is that what I'm looking at?
Pretty much. Definitely a very, very strong growth trajectory. Obviously, we don't have a lot of visibility now going into the subscriber numbers because that was the last time that they disclosed that. But I think we're still going to continue to see. I think what's going to be really interesting is when they start disclosing more advertising related metrics, right? That is where we need some visibility now. So whether they give us a more updated monthly active user number, the last number that they disclosed was 70 million, or whether they actually give us an actual, advertising revenue number. Those are going to become the goalposts, I think, in the near term.
Our thanks to Geetha Ranganathan, Bloomberg Intelligence Analyst on U.S. Media.
We move next to some news in the banking industry. We heard that Goldman Sachs is promoting a slate of star executives to run its biggest Wall Street business lines as part of the firm's revamp.
For more, we were joined by Todd Gillespie, Bloomberg Finance Reporter.
We first asked Todd what Goldman Sachs revamp actually means and who is involved.
To most people, they won't necessarily know the names outside of the finance industry either, but these are big people, rising stars, up-and-comers, many of whom have held senior posts at Goldman Sachs for a long time already. But the idea of this is creating a new layer of management, basically, and promoting a lot more people. 15 new names are going to be sitting on Goldman Sachs' management committee. That's up from 24. So in total, we're talking about a 39-person management committee, which is quite an expansion here. And now equities will have 3 of its own heads, fixed income business will have 3 of its own heads, and the banking business at Goldman Sachs will also have 3 heads as well. And those people will report into heads of each of the overarching umbrellas at Goldman Sachs, who then obviously report into the C-suite there. So, it's quite a big shift.
I don't like it. It just layers on another layer of management. Where is the value added here? I read this story, which was a great story, by the way, and I feel like they're just rewarding people with titles.
That is certainly one of the concerns, but right here, you've got to look at the context of the industry, right? What is Goldman trying to do by doing this? They're trying to wrest off competition from the alternative asset management industry. They're, who's already been trying to poach top executives from Goldman Sachs. We've had John Waldron just last week handed an $80 million retention bonus to stay on for another 5 years, alongside David Solomon, who's looking very comfortable in his seat as CEO. So, the bank is trying to fend off this kind of competition from across the street. We all know right now that banks are not in as lucrative shape right now as private equity firms like Carlyle, like Apollo, for instance, who have been, reported to have approached people like Waldron already. So the bank is trying to, this is a defensive move as much as a promotional move for the people inside.
Does it work? Like, does it satiate people enough when they're promoted and stuff? Like, is it?
Well, Alex, we'll have to find out.
80 million in Waldron's a different story, but this class coming up.
Yeah, I mean, this has been in the works for a long time. I mean, this is a result of a year-long or so set of discussions, right? Okay. Where people know, that there's a restless, very talented, up-and-coming group of executives who want to be recognized. They want to see a path forward, and they hope, obviously the bank hopes by doing this, they're going to give them that path forward. It certainly doesn't end the internal politics. If anything, it also creates, the potential for new tensions and, and new fiefdoms. But we'll see later down the road how this plays out.
What's interesting, for positive for Goldman Sachs is, I think early in his tenure as CEO, Solomon, some shaky ground, some missteps, and people were, even suggesting maybe he's not the right person for the job. But boy, has he turned that narrative around. He seems from the outside very secure in his position.
Certainly, Paul. Yeah, I mean, the past 2 years have been a real turnaround for him. I mean, there was a lot of criticism of him early on for, missteps in the, the retail adventure that Goldman Sachs was going on with Marcus, with, with this, JV with Apple. It now has this cards business that it's trying to sell off now. There's a lot of, speculation about what's going to happen to that now, who's going to pick up that portfolio. But certainly, David Solomon, thanks to a bumper crop of earnings results that have come out the past year or so, the bank is looking on much steadier ground, and he's kind of consolidated his grip, you could say, perhaps, over this bank. And he's aware, but he's also he's aware that him being in the seat for longer will make other people unsettled, and the board is aware of that as well, and that's partly the reason for the John Waldron $80 million retention bonus that we saw last week, and it could explain some of the moves that we're seeing as well.
Our thanks to Todd Gillespie, Bloomberg Finance Reporter.
Coming up, we'll discuss Donald Trump's second term as U.S. president and what it may end up meaning for his legacy.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney.
And I'm Alex Steele, and this is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern
on Apple CarPlay and Android Auto with the Bloomberg Business app.
Listen on demand wherever you get your podcasts, or watch us live on YouTube.
We move now to some big news in the tech space.
This week, President Donald Trump announced SoftBank, OpenAI, and Oracle were forming a joint venture to fund artificial intelligence infrastructure.
This includes an initial investment of $100 billion, and the goal is to speed up the development of AI technology.
For more, we're joined by Anurag Rana, Bloomberg Intelligence Technology Analyst.
We started off by asking Anurag what this announcement means for building AI infrastructure in the U.S.
We know the funding is going to come, and there's a lot of funding coming into AI data centers. Now it has the blessing of the U.S. government. It's going to be funded by private equity or private investors. Oracle's going to be the biggest cloud provider here, and OpenAI models are going to run on it or train on it. So it's a good thing for all three of them, obviously, but it's also good for AI advancements. The interesting part is Oracle is not even the top three cloud providers that's out there. It's led by Amazon Web Services and then Microsoft and then Google. So them getting a piece of this pie is a very big deal for them, because it's a very small business for them right now compared to what AWS generates in revenue.
So how about the other big cloud players? What are they thinking? Not being involved?
I think if you see when the rumor first came out that this is happening, you saw that Microsoft started to, trickle down a little bit, because right now Microsoft is the exclusive partner for OpenAI. Microsoft has outsourced some work to Oracle because they can't take care of the whole capacity. Then after the announcement was made, OpenAI and Microsoft issued a joint press release saying that they're renegotiating their own contracts in between, and currently their joint venture or partnership will be extended into till 2030. Now there are two parts of why OpenAI uses Microsoft Cloud. One is to train their models. Now that's the expensive, that's really where a lot of the CapEx is going. In that area, Microsoft will give, allow other cloud providers, but they have the right of first refusals, which means they will figure out whether they are okay with Oracle doing it or not. It seems to me that they're okay with Oracle because they have already outsourced some work to Oracle. I don't know if it's going to happen or if they're going to share that with AWS. We'll see that. But the biggest piece of it, the revenue sharing, is if you use OpenAI technology to develop an enterprise application, what we call as inferencing revenue from APIs, Microsoft still controls that. That's going to run on Microsoft Cloud. So Microsoft also got the best of it, which is the reason why Microsoft is up 3% also in this game today.
So here's my really dumb question. What are some hurdles here, aka power and permits?
Yeah, but that's where the government is saying they will help you out or help these companies out in taking care of it. That is definitely.
What does that entail? That means like speeding up a permit process or like allowing coal plants to run? Like, what does that really entail?
I think coal plants must be tough because, frankly speaking, it is very difficult for a cloud provider not to use renewable energy. I think there's going to be a lot more talk about nuclear, for example, what we heard with Microsoft going through. They will build they may build their own smaller, you could say, capacity to run some of these things. They have the money to fund it, obviously. If it's 100 billion spending, we think maybe 25% of that goes towards, more tech-oriented stuff, whether it's chip, whether it's servers, whether it's, pipeline, connecting networking devices or cloud computing. And the rest of that is probably going to go to more the building of the data center and, the cooling units, all that stuff that goes with it.
So, Anurag, when I think of the electric vehicle business, I think of a business that China is actually leading the way. They are ahead of the U.S. and European automakers. For AI, which is arguably a much bigger business opportunity and a longer-term one, perhaps, where is the U.S. in terms of a leadership position? It feels like we're putting the resources behind it.
Well, we have NVIDIA chips, so that really makes a very big difference at this point. One of the things we don't know about China is what are they doing on the AI side in the government? That's not publicly available anywhere. So it's a difficult guess for somebody. But one thing is for sure, if you have a lot of private money coming in, and we have the capacity. As I said, Microsoft itself this year is going to spend $80 billion in capex. We think it's going to be closer to 85. So if you look at all these large companies with a $1 trillion plus or $2-3 trillion market cap, they can raise funds and get a lot more AI investments. And now the government is getting involved in it. So I would say in all directions, it seems that U.S. will not let this one slip, and it's going to make sure that we remain the dominant force out there.
Well, then speaking of, in terms of say Microsoft and their capex maybe hitting 85 billion, was this money that everyone was already planning to spend? It was just now packaged in a nice little wrapper to everybody?
Not from Microsoft point of view, because Microsoft is not part of this, spending ecosystem. So Microsoft is going to spend this, but now good part is going to be Microsoft may not have to spend this much going forward, because as I said, the biggest bulk of that spending was going towards helping some of these large language model providers train their models on it. Now, if that's done with external money, the likes of private equity or SoftBank, then Microsoft is not going to take that margin hit, or investors are not going to ask them, you're spending $80 billion. Where is the corresponding 80 billion revenue in it? So I think it really helps Microsoft also down the road.
And to come back a little bit for SoftBank's Masa-san here, he's back on the big stage.
Yeah, it's been miss and hits for him for some time, but one thing is for sure, the addressable market of everything AI related is going to be so large. They specifically mention a lot of healthcare initiative. If you remember, when you look at Larry Ellison's acquisition of Cerner, he's spending a lot of his personal time trying to fix that healthcare system, which, to be very honest, is probably the biggest burden on U.S. GDP right now because of the high amount of healthcare spending we do as a country.
Our thanks to Anurag Rana, Bloomberg Intelligence Senior Technology Analyst.
This week, we also focus on a Bloomberg Big Take story titled Trump Shows He Is on Competing Quests for Legacy and Revenge. You can find this on the Bloomberg terminal as well as Bloomberg.com.
The story looks at how President Donald Trump's attention is divided between policy victories and exacting revenge on those he considers his enemies.
For more, we spoke to the story's author, Nancy Cook, Bloomberg Senior National Political Correspondent. We first asked her to walk us through what that story is about.
Well, it's really about sort of these two impulses that he has and that his aides are really thinking about as he, begins his second term in the White House. And the first impulse is really to, govern well, leave a legacy. Some of his aides for the last few months have been talking about sort of wanting him to have as big of a legacy as Ronald Reagan. They want him to preside over a booming economy, energy exploration, getting what they see as immigration under control. And they really want, his success to be built around governing. But there's a whole nother crew of Trump MAGA people who really also want retribution and revenge to be a part of that. They want people to pay for the investigations that they say Trump endured. They want people to pay for, coming after him with legal challenges, the Jack Smith investigation, the New York hush money case. They want people to pay, and also just critics, career government officials who maybe raise questions about Trump's first term. This crew wants Trump to pay. And so the story just really talks about how the competing impulses of Trump's first term is going to be between sort of wanting to govern well, but also wanting to get revenge. And I think that a central theme of his presidency this second time around will be what the balance of that looks like.
Nancy, do we have any idea who President Trump really listens to in the second administration? It seemed like in the first administration you had Jared Kushner and Ivanka there. Who's got his ear these days, do you think?
Well, it's a different crew than last time. I would say Susie Wiles, who is his chief of staff and the first female chief of staff at the White House ever, really is hugely respected. He really listens to her and really takes her counsel. She's worked for him, on and off since 2016. She ran his Florida political operations in both the 2016 campaign and 2020, and then joined him, his campaign full time when he, decided to run for a third time. They are very close, and he does listen to her. And then she has a group of very loyal aides around her who worked on the campaign. And I feel like, it's a pretty well-oiled machine. And a lot of those people were Florida-based. And I would say it's a really different staff than it was for his first administration.
What kind of legacy do you think President Trump is after right now?
I think right now he's feeling good and he's not feeling under attack. And so I think right now he, is probably a little bit more drawn to the Ronald Reagan model. But you have to remember he also pardoned 1,500 January 6th people, including people who violently assaulted police officers that day. And that is also part of the revenge. And so I think, it's going to vacillate between one and the other. I do think that he thinks that he could be a better president than people give him credit for. Biden thought the same thing. And so we'll have to see what, happens over the next 4 years. He and his team are riding high right now. They feel like they won all 7 battleground states. They put together a new coalition, brought some new people into the Republican Party. And so I will be curious to see, what happens a year from now or 2 years from now when they're not riding as high or when he feels under attack and what that looks like at that point.
Nancy, what do you think are kind of the to-do list for the first 100 days? Is this a president that views these first 100 days, as other presidents do, as a time to really get stuff done?
He signed a ton of executive orders, everything related to immigration, energy, the federal workforce. He's really hitting the ground running. Susie Wiles, his chief of staff, has told people that she views the first 100 days as kind of an artificial metric. They are really looking at the first 2 years as the key time to get things done. That's when we know that Republicans will control both the House and Senate. The Republicans have total control right now in Washington. And I think that they view the first 2 years as the key time to get things done.
Right. So I was wondering, it's really until the midterms, right? When things may change. Also, any leverage that President Trump may have over individual members that are up for re-election, that might change as well.
Yeah, that's absolutely right. And you have to remember, he's a lame duck president, too. He can't serve again. And so I think that they view that, too, as part of this calculus of the first 2 years of being very important. But we're already seeing them move at a very dizzying pace. And I think that that's going to continue.
Immigration, deportation, how aggressive do you think the president can be here?
Well, he's already trying. I mean, he signed executive orders to change the asylum process, to shut down the border via a national emergency. They were canceling immigration appointments that people had already that were legal immigration, people trying to come here legally. And so I think that Stephen Miller, who is sort of the architect of his immigration policies, is a deputy chief of staff in the White House. He has a huge amount of power, just like last time. And I think that he is telling both members of Congress, but also he's telling Trump himself that, you need to move quickly on immigration. This is a quote unquote quick win for us. And so I think that they are going to spend a lot of time in the first 6 weeks to 2 months on immigration.
Our thanks to Nancy Cook, Bloomberg's senior national political correspondent.
Coming up on the program, a look at corporate earnings in the aerospace industry.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BIGO on the terminal. I'm Paul Sweeney.
And I'm Alex Steele, and this is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch the program live weekdays at 10 a.m. Eastern
on Apple CarPlay and Android Auto with the Bloomberg Business app.
You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
We move next to the aerospace industry. This week we got earnings from American Airlines and GE Aerospace.
American Airlines forecasted a surprise first quarter loss as a carrier works to win back corporate travel after a strategic blunder last year.
Meantime, General Electric Aerospace, GE Aerospace, exceeded Wall Street expectations for profit and sales in the fourth quarter.
This comes as the jet engine maker worked through supply chain limitations and capitalized on a strong maintenance backlog.
For more, we are joined by George Ferguson, Bloomberg Intelligence Senior Aerospace, Defense, and Airlines Analyst.
We first asked George for his take on results from American Airlines.
Yeah, so I mean, on an adjusted basis, though, American looked fine in 4Q. It was all about their 1Q guide, and that was guided at a loss compared to their peers, United and Delta. So, I mean, American looks like they're just going to add less capacity in the first quarter, and that's going to make it more difficult to manage expenses. Expenses will be higher than peers, and so their performance just won't be as good. But I guess what I would say, though, is American's 4Q earnings, their revenue growth in all markets looked better than their peers, on par or better. So American a couple of years ago decided on a new strategy where they were going to try to do less agency ticketing, through travel agencies and such, and more direct. That kind of backfired. They've turned that around, and they're going back towards a more traditional distribution of tickets. And I think it's starting to show up in the financials now. Again, I think 4Q looked pretty good from a revenue performance. And so I would expect that 1Q is probably a bit of a glitch, as they're just not going to put as much capacity in the marketplace, manage a little bit higher expenses. But I really think that they're closing the gap and will continue to close the gap with United and Delta as they roll through 2025.
So when do they expect them to catch up and sort of reverse the mistake that they made? Like, when does that resolve itself completely?
So, I mean, I was looking, at just some of the differential in yields, price paid per mile flown at the carriers. Delta's still the top dog, but American's only sort of 3% behind. It's always hard to figure out exactly when the catch-up's going to occur. Is it going to occur in the next couple of quarters? Probably not. I think it'll take a while, but I bet you they make a lot of progress during 2025. I mean, it's a pretty competitive marketplace. There's a fair amount of overlap. I don't think, American's hubs probably aren't as great as Delta's and United, but I would expect they're going to close a good portion of that gap this year.
I'm just looking at valuation on a PE basis. American, got an 8 handle. United's around 10 times. Delta's the premium at 11, 12 times. What drives the differential in valuation for these three companies? I kind of think of them as kind of all kind of the same, but the market doesn't, does it?
It doesn't. Look, I think Delta does have, as you just pointed out, has the best reputation in the group. Again, they're the market leader in revenue per mile flown. I think they've done a really good job on their loyalty program. I think that's probably generating the most revenue of those big three as well. and that's really nice, high-powered revenue, right? A lot of it flows to the bottom line. So Delta's clearly the market leader, and again, I think it's that loyalty. I think there's a real desire to fly Delta. There's sort of this Delta cult out there. United's been kind of closing that ground. United has a very strong international network, and I think we've really seen that recently with, there's very good demand, very strong demand to go transatlantic right now. Mm-hmm. Americans, the dollar's strong. Americans apparently want to go there in the depths of winter now, even because we just can't get enough Europe after the pandemic. I don't know how long this lasts, maybe as long as the dollar is this strong. But I think that's been really shining through in United and helping them close some of the gap. They still have work to do on the loyalty side, and I think the domestic side of their network. And American has kind of been the laggard. And again, I think, their international, especially international into Europe, isn't as good, I think. And into Asia is much less than those two carriers. And American just doesn't have the loyalty program as strong. So I think they've been more highly levered than the other two because they've gone through fleet refreshes earlier. So that's sort of why they're the laggard. But again, they all operate in the same marketplace. There are some nuances to their hubs, but it's hard to see any one of them walking away too far from the others. And I think that's why we're seeing this convergence in the full service. We'll see it.
George, we have a little over a minute left, but I didn't want to let you go before we talked about GE and what that read-through in their aerospace division meant for Boeing.
Yeah, so strong. GE's got, the maintenance business really powering cash flow and margins. They guided to next year. They show cash flow and profit not growing as fast as revenue. Story there is I think you're going to see more deliveries out of Boeing and Airbus. We're calling for that. New engines are dilutive to margins, and so that'll take a little bit of the shine off that business. But everybody's flying everything as long as they can because it's hard to get new airplanes because of the supply chain problems, and that's really helping to boost that margin income at GE, which is, well into double digits kind of stuff. It's great stuff.
Our thanks to George Ferguson, Bloomberg Intelligence Senior Aerospace, Defense, and Airlines Analyst. Each week, we take a look at research from Bloomberg NEF, previously known as New Energy Finance.
They're the team at Bloomberg that tracks and analyzes the energy transition from commodities to power, transport, industries, buildings, and agricultural sectors.
This week, we took a look at what a Trump administration means for the energy transition. For more, we are joined by Derrick Flakoll, Bloomberg BNEF's lead U.S. policy analyst.
We first asked Derrick, what's the substance of Trump's recent executive orders on energy, and if we're in need of an energy emergency?
From a sort of market perspective, the answer would arguably be no, certainly from a supply amount. The U.S. is the world's largest producer of oil and gas. There is an argument to be made about price, which is certainly the basis of the Trump administration's order. But more to the point, declaring an emergency doesn't have a sort of clear legal basis or restriction. It's a thing that's more or less the discretion of the president. So he does have the power to declare this. The substantive implications, of course, might be somewhat different. There's not a lot of precedent for a national energy emergency. The closest would be the 1970s, where there was a large amount of regional emergencies declared. There might be some ability to ignore or look past normal environmental rules or restrictions that could slow the construction of energy projects. But of course, this would require a lot of cooperation with perhaps state and local authorities and certainly the private sector to really build anything out. And the implications on prices remain to be seen. It takes a long time to build anything, and that means a long time to have an impact on prices.
Hey, Derrick, just from at that 30,000-foot level, what does a President Trump presidency mean for just alternative energy in general, maybe wind in particular?
Sure. So zooming in on wind, there's a bit more vulnerability than a lot of other energy sectors because in offshore wind, there's reliance on federal permits. Everything is basically on the federally owned seabed, as well as federal leases. So those are two different areas where the president has a lot of leverage to halt new leasing or new construction. Trump has already done that with one specific executive order. Onshore wind is a little bit different. Unless it's on federal land or impacts certain federally regulated waters or endangered species, you're not going to need a federal permit for that. So that's a bit more limited there. And then when you're looking at solar and storage and other factors like that, it's not really as affected by Trump's orders. He did pause certain forms of funding from the Inflation Reduction Act, the Infrastructure Investment and Jobs Act. Those are the sort of Biden-era signature clean energy subsidy laws. But by my understanding, that shouldn't really be affecting the tax credits, which are driving a lot of deployment. and state-level regulation in the power sector, which is a major driver, continues. You're still going to see demands for clean power for utilities in California, Michigan, a wide variety of states. And in places that don't have those standards, like Texas, there's still a really substantial amount of solar and storage build, not because of regulations, but because of market demand, because it's quick to build and meets load growth pretty quickly. So he can't really stop it, but he can slow or complicate it in various ways.
And I hear you on the tax credits that has to take, an act of Congress, but that would be pivotal for a lot of these companies. The other part, though, has to do with the deployment of cash. So the Department of Loans issued a boatload of money right before. I mean, they've been trying to get rid of this money like crazy for the last 4 years. Where is that money now? Like, is it just like dry up and go away? Can Trump recall any of these loans?
So recalling that will be pretty tricky. A large amount of those loans have now been committed from the Department of Energy's Loan Programs Office. Both an active loan and a conditional commitment are considered obligated, as far as my research has told me, which means that it's basically contractually assigned to a private company. That means that it's pretty difficult to claw that back. The active loans, of course, are even more difficult because once a business is actually enjoying the benefits of that, you're building a factory or opening a mine, it becomes both legally and politically trickier to pull that away.
So when we sit back, Derrick, what's the reality here? You mentioned wind, where there is some opportunity for the federal government to slow things down. But how about other areas of alternatives? Is that going to need cooperation of Congress, private sector? How do you think that might play out?
Well, it definitely requires a lot of cooperation on both ends. Firstly, from the sort of utility scale deployment side of things, again, you're still looking at a lot of state-driven demand for build out, either regulatory or market. Secondly, if you're trying to really cut the tax credits or slow deployment that way, you do need Congress's approval to really substantially change the rates. Over the longer term, maybe 2 to 3 years, you could see Trump reversing some of the finalized Biden administration regulations in a way that might make these credits harder to access, but that's going to take time. And on top of that, in terms of other parts of things like, oil and gas access, things like that, that's going to be driven heavily by private sector decision making, right? You can lower a bunch of barriers, but you can't really say to energy producers, okay, we're going to make you produce at an amount that basically reduces your profitability. And one last point I'll make, something that ties into all of this, fossil and non-fossil infrastructure, is permitting reform, and that is mostly going to take an act of Congress. In particular, it's probably going to take 60 votes in the Senate, which means 7 Democrats coming alongside. You can't really easily fit that into a reconciliation bill, which is primarily about taxes and spending, and can get you 50 votes passage in the Senate.
Our thanks to Derrick Flakoll, Bloomberg BNEF's lead U.S. policy analyst.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.